Everybody, what's going on? It's Bill with Franklin Loan Center, and actually, it's crazy. Vicky, my wife, yesterday sent me this meme that was talking about how, like in 1971, interest rates were 7.3%, and they didn't get under 7.3% for like over 20 years, and all that waiting would have cost, like prices tripled or whatever they did, right? So it just got me going on like, wait a minute, like, is that, like, how is that possible? Because all I'm ever hearing is how interest rate, and quite frankly, this is what conventional wisdom would tell me, is as rates continued to go up, it had to crash the market, right? I mean, it had to pull rates down, pull values down. How else could it work, right? Well, turns out we have a period in history where it proves otherwise, and it's not just this one, right? So back in 1971, rates were and this is all like by Freddie Mac, and by the way, Freddie Mac was put into existence in 1971. That's why that's the date you hear all the time. So in 1971, over here, rates were at 7.33%. 10 years later, in 1981, you can barely see this. Let's see. You can see they maxed out at 18.6%. Why? Inflation. Sound familiar? Right? So we saw this massive run up in interest rates. The interesting part is then you go down here to median home prices, right? And this chart doesn't start in 1971. It starts, here's 1971. In 1971, the median home price was $24,300. Amazing, right? That sounds a lot more like a low down payment now. But anyway, and so in 1971, median home price, $24,300. In 1981, when interest rates were up over 18%, housing prices went to $66,800, right? So over the same time period that we saw interest rates go from 7% to 18%, we saw housing prices go from $24,300 to $66,800, which is a 175% increase in prices. How could that happen, right? Well, guess what? It's happening again right now. And I couldn't find this data, but I guarantee they went through long periods of minimal houses selling and things like that, just like is happening right now. But the thing is like, again, it's a big limiter on the supply. Meaning, look, if you have a great interest rate, you're not selling as rates are continuing to rise in a lot of cases. So that keeps the supply down. If the demand still stays strong, that's what happens, right? So it's interesting, that period, and God forbid this taking 10 years to get out of. We're already a couple years into it. But the crazy thing is over a period where we saw rates go from 7.3 to 18.6, we saw housing prices go up 175%, right? So, and you can see this chart. I know it's hard to see because it's a little distant, but you can see this is the long-term trajectory of housing prices. As long as there's more people being born than dying, that's going to happen, right? It's, again, supply and demand. So I just wanted to point this out. Thank you, Vicky, for sending me that meme, because it really got me thinking. And it really is interesting how, look, I mean, I think this is more evidence, or at least we've got another historical experiment that shows us that, no, it doesn't, just these interest rates going through the ceiling does not mean that we're going to see housing prices crash. All right, I'm Bill. I'm with Franklin Loan Center, and I'll see you all next week.